If I told you the Bitcoin ETF is just went from 170 billion to like 80.6 billion in just a 5 months, what actually will be your natural instinct? You probably think the institutions are selling, or they are literally in a panic mode, or the big money is already left from the market, etc. etc. But that's not what happened in the market right now. You need to understand the expression here. If the Bitcoin is went from $126 to like 65k, that almost like a 50% drop. Okay, when the price drop that much, the dollar value of the Bitcoin will drop that much. So that 170 to 80 is not just institutions are selling. If you look into the data very carefully, you can see that 94% of all the institutional capital are still in the Bitcoin. That never moved. So the summary is institutions doesn't move their allocation, the price is just changed. Now let's get into the main story. If you understand the rails where institution has to use, you stop guessing where the capital might go. Instead, you will start asking where the capital cannot go. Institutions don't just buy Bitcoin in a spot like an exchanges. Most of them use ETFs, and those ETFs run through a regulated channels like authorized participants or like creation redemption windows with a strict compliance rules. So the large funds can't move the fund very flexibly. They need to operate in a fixed system. So everything in this institutional market will fit into the four tiers, or you can call it as a four rails, or four behaviors, or four ceilings. So let's get into the detail of each tiers. So the tier 1, spot Bitcoin or Ethereum ETFs. This is the primary rails where most of the institutions are using. Completely regulated and custodial, and it's reported through the 13F filings. And some of you guys don't know what is the 13F filings. If you are a large asset manager, like maintaining more than $100 million of assets, you are legally required to disclose your positions. That means tier 1 exposure is really visible and verifiable and transparent. And the total AUM for the current tier 1 assets are like 80.9 billion, and IBAT alone took around 57 billion in assets. And other banks are like Goldman Sachs 2.34 billion and Millennium Management like 2.6 billion. So these rails are built for the capital preservation, not for the speculative activities. The money will enter here fast and it exists fast as well. Now tier 2, blockchain equities and treasury companies. This is actually an amplified rail. So what actually it means that instead of buying Bitcoin directly, institutions will buy the companies that hold Bitcoin. It will be much more easier, and it can simply add into the traditional portfolio and it trade like a stock. When like Bitcoin moves around 10%, this company can move 20 to 30%. That's the amplification here. Strategy is the clearest example here. They are actually holding around like 720k Bitcoin. That's literally 3% of all the Bitcoin that currently exist in the market. They were acquired, it is for a 54.77 billion. At average cost of each Bitcoin was like $75k, and it is still well above the current market price. The interesting thing is that in the last week, they literally added 204 million additional BTC. So look at this thing, like if you are still below the average cost, in that case, if someone is buying or like keep buying more, even though the price is below what you paid, that actually not a gambling kind of stuff. It actually a conviction signal from these type of companies. And now the tier 3, on-chain, yield and stablecoins. This rail is still forming in the perspective of institutions, like it's semi-permission right now. The regulated access is just begun. The interesting number I can mention here is that Solana's staking ETF just crossed around like 1 billion within 1 month right now. And in the case of stablecoin, those legislations are still formalizing right now. So you can consider this tier isn't formed fully, it's under construction. So it needs some more tier to institution to enter into this kind of tiers. And the last tier, tier 4, the speculative altcoins. It's a retail territory, no institutional custody framework, no 13F reporting, and no transparent capital rail. The money will only flows to these rails only after the upper rails get overflowed. Right now, they are not overflowing, they are actually in a stabilizing mode right now. And this framework will directly connect to our episode 1 of this series. If you haven't watched it yet, just watch it after this video. Then you will get a much more better understanding of all the institutional structure we are talking. Now let's look into the states of each tiers, like where actually each tiers is standing right now. So in the case of tier 1, it's actually in a defensive but not in an exiting state. When Bitcoin broke below 85k in January, the Goldman and Millennium just reduced their exposures. There was around 817 million in outflow in one session. This was not actually a strategic exit. You can consider it was a risk reduction. And possibly there's a chance for leverage unwind in the case of institutions as well. In the institutional strategies, they are actually maintaining some leverage positions as well in the case of portfolio, like the future overlays, like basis trades, and they will have some kind of hedging mechanism like risk models kind of stuff. So there's a huge chance for the leverage unwinding in the side of institutions as well. So when volatility spikes or the key level just breaks, those model they are using, like the leverage positions in those model, forces to sell the exposure. This can be a mechanical selling pressure from the institution side as well. It's not a permanent selling. So on the summary, they're actually in a defensive mode, like they are reducing some risk and waiting for the next confirmations. And you need to remember one thing is that they are still holding their 94% position of the ETFs. So it is a clear sign that they are not abandoning anything. Now in the perspective of tier 2, like blockchain equities and treasury companies, they are in aggressive accumulation mode right now. As we discussed previously, in the window of February 23rd and March 1st, the strategy bought around like 3015 Bitcoin with an average cost of like 67k. And their overall average cost is sitting around 75k. That means they are down around $80 per Bitcoin. They are still accumulating even when in the downward trend. So in the case of tier 2 companies, they are fully in a long-term conviction. They are not reacting to any volatility and they are building through it. Now in the case of tier 3, the on-chain activities and yield and stable coins, if you look into that current state, the long-term holders selling just dropped around 87% within 24 days, like from 243k Bitcoin to like 31k Bitcoin. And if you look into the data, the large whales are started to accumulating in the mid-February and they haven't sold anything since. So these tires will move before the narrative shifts. Right now, they are actually in a positioning mode, not in a distributing mode. So if you are actually need to move ahead of institutions, but it won't be correct every time, you should need to look into these tier 3 positions. Now let's zoom out a little bit. We need to look into the distribution channels, like how the shifts are literally happening. Now the big banks and asset managers are just quietly changed their view on how they are looking to the crypto. Now the Bank of America is instructing their wealthy clients to consider like 1 to 4% of their portfolio in a crypto exposure, including the Bitcoin ETFs. So this shift just happened after the long caution they are put into the crypto industry. And Fargo is also started to distributing their Bitcoin products to their advisory network. So you can see that more traditional networks are opening for the crypto exposures. And Vanguard, one of the massive asset managers, like 11 trillions of assets they are actually managing right now. They had a caution view on the crypto previously, like they are blocked access to the crypto from their platform and for a long time. Now they are actually changed their long-standing policy and started to allow the crypto ETFs on their platforms. Even if their allocation they are recommending is pretty small, that still matters. If the 0.1% of the capital from Vanguard itself represent like billions of capital potential. So what you can see here is that the infrastructure is building in this correction phase, and that tell you that how one of the largest and most conservative money managers are thinking the crypto today in a different view right now. Now here is how the framework works right now. Not predicting that, just structure. In the case of tier 1, like the Bitcoin ETFs and Ethereum ETFs, it's actually stabilizing, not expanding thing right now. The outflow slowed dramatically, and also we saw around 500 million in ETF inflow in a single day. So that confirming that the selling pressure is actually running out. Now it in a stabilized mode. And in the case of tier 2, it's still accumulating. The strategy just made their 101st consecutive purchase right now. You need to understand the fact that they are still in a loss, but still they are making their next purchase. What that means simply here is that even the price drops significantly, the institution don't step aside, they keep adding. Not because of they are expecting a bounce back in a next week or 1 month. Instead, they are actually measuring the horizon in a years. So that means the volatility does not change their plan, it's only change the entry price. Now here is why I stand right now. I need to see the Bitcoin will close full week above like 68k and steady money inflow into ETFs. Until that happens, my most of the capital will still staying out. I am not going to move that into smaller, riskier coins. And here is one of the most interesting part that you don't want to hear. Institutions don't create dull season; they actually killed it right now. Because when large capitals regulated the way to buy Bitcoin, it doesn't need to chase everything else right now. And those rails like Altcoin rails don't support that market in the right moment. That also limit how much speculations we can do it on that spread. So let's wrap this up. Today you saw how the institutional money will enter into the market, where it sits, and the limits that rails creates. But that raises a bigger question here. When a pension fund will allocate to crypto, it's not looking for a like a quick 3x return. Those kind of capital need a steady return. And for the first time, part of this market will offer yield as well, not just the price exposure. And that changes everything. And this will change us an important question we will be asking for a long time. It's not just which token will go up, it's actually which networks pays the institutions to hold it. Ethereum and Solana looks very different here, like different yield and different risk. So in this architecture series, in episode 3, so like we will look into this demand for the yield, whether it can change how the crypto is valued, and most importantly, where the money will move next. I will see you there.